Now, President Trump has expressed support for Treasury Secretary Steve Mnuchin after questions about why he'd discussed bank liquidity when it didn't seem to be a problem. The president said Mnuchin is a talented guy and also appeared to row back some of his own criticism of Jay Powell as well. He, of course, has repeated his belief that the Fed is raising rates too fast, but said he's confident policymakers will, quote, get it pretty soon. Joining us now is Edward Stringham. He's president of the American Institute for Economic Research. Sharon O'Halloran is also with us. I want to get your perspective, Edward. Is there something for the Fed to get?
Well, you know, it's funny. The Federal Reserve is having to measure so many variables at any given time and getting criticism from so many different groups, including the president. I thought it was interesting that the other day he said the only problem that the economy has is the Federal Reserve. And I would say, I have to say, this is maybe one of the strongest overstatements. I do think the Federal Reserve can be destabilizing in the economy, and many times it is. But there's just so many different variables, and I almost feel bad for the chairman for facing so much criticism.
Is he a problem for the economy in general, do you think? Is there more the Fed or less the Fed should be doing?
Yeah, so the traditional view is that the Federal Reserve always stabilizes, or they always know what they're doing. A lot of my colleagues have talked about for a long time the potential that the Federal Reserve can destabilize. When they inject money into the system or they pull money out of the system, that can actually have ripple effects and be affecting real variables and not actually helping the economy.
Is it in any way impacting liquidity from your perspective? What was interesting, particularly around the market sell-off post the Federal Reserve's own meeting, was many seem to suddenly be worried about the balance sheet, whereas it hadn't really been an issue before that in any way they might pull back from their unwind. Do you think that the Federal Reserve is draining liquidity in any way from the system?
You know, it's a very interesting question about the balance sheet. We've got this huge skyrocketing of the balance sheet over the past 10 years. And they own a lot of securities and debt assets. And people have been talking about how should they continue that. I think it's an odd thing that they have all that money and assets. A lot of people have been saying they should be unwinding it, whether that's not renewing securities as they reach maturity, or whether that's an outright sell-off. I think that people have been talking about this for a long time, potentially expecting it. And I wouldn't say that per se is the cause of the recent downturn in stock prices. There's just so many things going on right now.
Does any of the reasoning behind the downturn in stock prices, whether it be Fed-related, whether it be trade-related, whether it be White House-related concerns, do any of them manifest in actually hurting the overall economy? Does the sell-off, the risk sentiment changing in the stock market eventually have an impact, real terms, on the economy?
Oh, sure, yeah. So the stock prices are basically a representation of current expectations of future profitability of firms, how well businesses are going to be doing in the future. So as businesses conditions start going down, that gets reflected in lower stock prices. So people, if you know the stock market goes down by 20%, they're expecting all these businesses to not be doing as successful in the future. That shows up in terms of opportunities for workers. That shows up for consumers as well. So the stock market is just an indicator of economic activity, future economic activity in the economy.
I'm pleased to say Edward Stringham is going to be sticking with us of the American Institute. We've also got Sharon O'Halloran of Columbia University, both going to be sticking with us. So let's have a quick check on the futures market now, because we are currently in the green when we're looking at futures. We're up across the board. We could see a little bit of risk appetite, but thin trading on what is the day after the festive break. Boxing Day, as it's known here in the United Kingdom, public holiday, but in the US, we've got trading set. S&P 500 futures, though, swinging wildly. This is Bloomberg. Still with us for their perspective on the consumers, Sharon O'Halloran, she's of Columbia University, and Edward Stringham of American Institute for Economic Research. Edward, I want to start with you. The consumer strength we're seeing in the end of the year, does that continue into 2019?
Well, I hope so. But you know who I feel bad for? Is the consumers who are going to have to pay more for their products because of increased taxes on their goods, specifically those taxes called tariffs. a lot of people think about we're going to punish the foreign producers, but the fact is they're taxes on American consumers, and those are actually going to hit people's pocketbooks. It's going to be taxing American corporations who are using ingredients from other goods, and it's also going to be taxing specifically foreign products that are bought by American consumers. So I think those are very potentially negative, and the more that we can move away from these harmful trade wars, I think the better off we will all be, especially the consumer.
Sharon, you're a trade expert. We're nicely dovetailing in trade perspective there with Edward as well as the consumer. How much of a concern is the trade tariff situation and tensions between China and the US for you from an economic perspective?
So I think it is actually important, especially at the intermediary goods level in the production process, because that's where you're going to have the most impact, both on downstream impact, and both on the consumer, but also in the supply chain. And that's going to have, is what we're seeing, a significant impact. So, but also, you're also seeing people shifting their production abroad, and that's where it's going to be really problematic. So yes, tariffs, problematic, but moving production abroad is even worse. So that's what I'm concerned about.
Yeah, Edward, you're saying that you're worried for the consumer in terms of the price they're going to have to be paying, the fact that businesses will eventually have to pay the price of these tariffs. Will it all backfire from an economic perspective, or will the trade tariffs in some way work if we do see an opening up of the Chinese economy? We did see just over this course of this weekend today yet more moves by China to alleviate tensions, certainly promising new rules, new regulations in particular, when it comes to promising to treat all companies equally.
Yeah. So that the ideal, from my perspective as an economist, is a world without tariffs, a world without taxes on consumer goods and production goods. And if that's the goal, then we might be thinking about being optimistic. If China's actually going to be reducing tariffs on us and we're not going to be having tariffs on them, then that's good. That's more free trade. That's what every economist wants. What was alarming was a few weeks ago when the president announced, he said, I'm a tariff man. And there he's seeming to think that this is the long run ideal. So you hear a little bit of tension in his thoughts. Sometimes he'll say that the ideal is a world without any tariffs. And other times you think that these are going to be permanent. So if the goal is to increase trade restrictions, I'm not optimistic, but yeah, I mean, I'm hoping for the best. If China opens up their markets to us more, all the better.
Sharon, give us your take there for what 2019 brings from the economic perspective. The economists out there think, look, we're still going to be above trend in terms of overall growth. Do you think that will be sustained?
It does appear that the economy is still growing from everything that I'm seeing. What we see is that there is a lag in the trade aspects that are going forward, that there will be an uncertainty in some of the investment that may be slowing. Consumer demand does not appear to be slowing down yet. Again, that's in the U.S. economy, it's about three quarters of it, and government spending is still high, as we all know. So all of those components are still there, but there is growing drag. So yes, I would assume, but you have the interest rates increasing as well. So those are the counters that we should be seeing. So it should be increasing, but not at the same rate. And I don't know if it's sustainable.
Slower growth to come, and we'll see whether that growth does remain sustainable. Great to get your perspective, Sharon O'Halloran of Columbia University, and of course Edward Stringham of the American Institute for Economic Research. You'll be sticking. I'm Caroline Hyde in London, but there is a beautiful dawn breaking in New York. S&P 500 futures also looking slightly prettier. We're up 0.5%. That is 12.5 points. But let's have a look at what is the single best chart I've got to you as a look back of what's happened to the S&P 500 over the course of a year. Not so pretty. We're currently off by 12.3% over the course of a year, but we are close to a 20% nosedive from the previous highs. That means technically we are just 7 points off a bear market. We could push that slightly higher to 20 points if we do indeed hold on to those gains in the S&P 500 futures. However, we still very close to the edge of a bear market when it comes to the S&P 500. Let's get the take of our guests, Sharon O'Halloran of Columbia University and Edward Stringham of the American Institute for Economic Research. I want to start with you, Edward. When we see charts such as that, do you think the market is out of whack with the economy?
It's always very difficult to say, and I would say the best indicator of where we are in the economy right now is current stock prices. I wouldn't want to second guess the large investors out there, the small investors out there. I do think we need to look at these things in the long-term perspective. Oftentimes when we see things go up to a record high and then it goes down a little bit, everyone starts, freaking out. It's the end of the world. And there's definitely a lot of cause for concern that things are not going as well as they could be or should be. But from a long-term perspective, I mean, things have been going up quite a bit over the last few years. And it's unfortunate when they don't continue to go up even more. But we have a lot of positive things in the economy, record low unemployment rates over the past 50 years. We're still at that. And things are doing well. There's deregulation, tax cuts. All of that, however, is being tempered, I would say, by unnecessary barriers, trade barriers, and different things that are potentially getting in the way of markets.
And those markets at the currently S&P 500 on track for its worst month since 2008. Sharon, your book was all about the ramifications of 2008, all about the previous financial crisis, and whether or not we are setting ourselves up for a second one. The liquidity concerns in the market at the moment, how significant are they to you? Because certainly they were amplified, perhaps unnecessarily, by Treasury Secretary Mnuchin. But is it something that the market is paying attention to the right extent, do you think?
So I would not have anticipated that liquidity concerns were a big issue now, especially with all the capital requirements, all the stress testing, so forth. I thought, from what I had seen, that there was ample liquidity to cover all the various obligations out there, even with the leveraged loans in the corporate debt sector. However, obviously, when you put in a whole notion of confidence and people start getting really concerned about that, then you could have a run on liquidity and people could start using their credit lines and so forth, and you can actually have an artificial crisis. And therefore, all of liquidity could be drying up right now because of the signals that were sent by the government themselves. So they've created a crisis in and of themselves, and that's a problem. So those are the types of concerns that I have just looking at this last week of the scenarios. But really the crisis really was the failure to identify, manage, and mitigate risk, and what at the individual firm and the systemic level. And then we have to ask ourselves, have we done a better job at that going into these types of cases that we're looking at now and these stresses, and do we have the tools available to actually mitigate them? And that's where we are.
Edward, what's your number one risk for you as we go into 2019? And your number one optimistic note?
So bad regulations, interference with the economy. We've got this constant back and forth, I would say, between these people who actually, I would say, businesses know what they're doing, and then you've got people coming in from the government saying, hey, you know what, we're going to, prevent you from buying foreign goods. We're going to prevent you from hiring foreign workers. We're going to put up a wall to prevent American corporations from hiring foreign workers. So all of this tension that we're creating is artificial. We've got the potential for world peace through markets, and that's getting interfered with. So I do think that's a major risk. On the other hand, if we withdraw from that, encourage more trade, I could be very optimistic.
Artificial risks, but reasons to be optimistic. Sharon O'Halloran of Columbia University and Edward Stringham, of course, of the American Institute for Economic Research. Great to have you both. We thank you. Stay tuned. We're going to be speaking with them on radio next. This is Bloomberg.